Hi there, this is Simon, personal finance coach. Figuring out when to sell a stock can make a big difference to your investment portfolio. Deciding what stocks to sell and when could be a tough decision to make. The circumstances for selling a stock might be different based on investment strategy because your investment strategy drives the important factors that need to be considered. So in the first part of this video, I will discuss one of my investment strategies and explain when I decide to buy or sell a stock. And in the second part of this video, I will describe scenarios independent of any specific investment strategy as to when to sell and when not to sell a stock. In the meantime, please subscribe to this channel to get notified when new videos are available. I am what's so-called a GARP investor. GARP stands for growth at a reasonable price. GARP investors look for companies with strong growth potential, but at a reasonable valuation. This approach combines elements of both growth and value investing. I invest in growth stocks with the best fundamentals at the most compelling valuations. Each stock must have a theme that I have conviction in. I'm looking for stocks that have a 50% upside in the next 2 years and 100% upside in the next 4 years. These stocks have the potential to double much faster than 4 years if the right entry and exit points are chosen. With this approach, I'm trying to maximize profits as much as possible. Typically, I'm going to own 20 to 25 core holdings, each positioned at over 3%. I will go up to 10% in a position where most of that over 3% is due to capital gains. I am careful not to trim my winners aggressively because I want to ride them for years until there is a change in fundamentals. If I find the right stocks, I hold them for 2, 3, or 4 years. During this multi-year time frame, macro conditions may alternate between headwinds and tailwinds, so I try not to get caught up in short-term fluctuations. I also have 5 to 10 entry holdings in my portfolio. These are new stock entries with stock fundamentals and a theme, but there is something that I don't like enough to start with a larger position. I build the entry position in 0.5% increments over time, usually through dollar cost averaging or on pullbacks, until they reach the core holding level of over 3%. The entry holding approach also allows me to exit the investment if I observe that buying a stock was not the right decision. If I'm excited about the fundamentals and the valuation and I maintain an investment thesis, I will add stock on pullbacks. Fundamentals for me consist of 4 metrics: positive earnings, cash flow generation, revenue growth, and earnings growth. I avoid companies that don't make money at the bottom line. The valuation metrics for me consist of 3 metrics: price to earnings ratio, known as PE, earnings growth, and price earnings growth, known as PEG. Another aspect of my GARP investment strategy is that I don't stay married to my stocks. I date my stocks, and I keep dating them as long as fundamentals stay strong, valuations make sense, and the investment thesis is in place. I'm going to trim my holding position or exit the investment if the fundamentals start to change or if something in my investment thesis starts to break down. For example, when a company that has been doubling its business year over year experiences a slowdown in growth to the 30 or 20% range, that indicates a change in fundamentals. My strategy may evolve over time. The pivot of strategy depends on the general market conditions, such as interest rates and inflation, as we saw in years like 2022 and 2023. GARP investment strategy: when do I sell? I sell in the following 5 scenarios. Scenario number 1, when fundamentals change. Since I choose stocks with the expectation of having 50% upside in 2 years and 100% upside in 4 years, if revenue and earnings growth of a company slow down, I sell because the expected return is no longer feasible. Scenario number 2, when valuation changes. If revenue and earnings growth no longer truly represent the company's value, I sell. This happens when the price to earnings and the price earnings growth metrics become too high for the company compared to the other companies in the same industry segment. Scenario number 3, when investment theme change. An investment theme is a specific trend, idea, or concept that is believed to drive an investment opportunity. Examples may include AI robotics, electric vehicles, or aging population, among many others. I sell once the original investment theme driving the investment in the stock becomes invalidated. Scenario number 4, when stock appreciates to over holding limit. I typically build holding positions in 0.5% increments over time until they reach holding levels of over 3%. When a holding exceeds 10%, I will trim the position back to 10% or less, depending on my assessment of how much potential the stock still has ahead of itself and based on my conviction level in the stock. Scenario number 5, when regretting opening an entry position. When I opened a 0.5% entry-level position in a stock and discover that there are fundamental changes in financial numbers, or find inaccuracies in my thesis assumptions, or the stock dives by 15%, I will sell the stock. These are the 5 circumstances when I sell a stock as a GARP investor. Note that different investment strategies may have different additional scenarios triggering a sale of a stock. So in this second part of the video, I'm going to summarize general cases that are independent of any specific investment strategy as to when to sell and when not to sell stocks. Here's a look at 8 scenarios where you might want to sell. Scenario number 1, when fundamentals of the stock have changed. Scenario number 1, when fundamentals change. All companies change over time, sometimes for the better and sometimes for the worse. This type of change can come in many forms. Companies that earn high returns often face stiff competition that could bring their returns to more normal levels. Other times, businesses face total disruption from new technology that threatens to companies' very existence. New laws and regulations can get introduced, new management can take over, or a change in the core mission of the business, among many others. If the company you own is no longer the same company that you first invested, and you no longer have faith in its future, it's a good time to sell your stock. Scenario number 2, when the valuation no longer reflects business reality. Occasionally, markets can get overly optimistic about the prospects for a business, bidding its stock price up to unsustainable levels. When the price of a stock reaches a level that cannot be justified by even the best estimates of future business performance, it could be a good time to sell your shares. There are many historical examples of markets going ahead of the underlying business fundamentals, leading to underperforming stocks for years to come. Price eventually follows value. Scenario number 3, when your investment theme is no longer valid. When an investment theme in a stock is no longer valid, it means that the original thesis or rationale for investing in that stock based on a particular trend or idea has become outdated, irrelevant, or no longer applicable. This can happen for several reasons, such as market saturation, technological disruption, regulatory changes, major economic shifts, or a company-specific issue. When the investment theme is no longer valid, it might be a good idea to reevaluate the investment and possibly sell. Scenario number 4, when you rebalance your portfolio. Rebalancing is when you adjust the holding in your portfolio to the intended asset mix. It is an important part of a long-term investment portfolio management strategy. If you had a stock that performed particularly well, the single holding gets too big, and you might consider selling it back down to a lower level weighting. For example, if your rule is 10% limit on a single stock investment, and your stock climbs to 15%, you will want to sell some stock to get the holding back to 10% or lower. Or if you have decided that your strategy requires 60% of your portfolio to be in stocks, but it climbs to 70%, then you'll have to sell some stock to get the portfolio back in line. Rebalancing makes sure that your preset portfolio rules are met. Scenario number 5, when you make a mistake in assessing a company. Mistakes happen, and the sooner you realize it, the better. Sometimes it turns out that a business isn't what you thought it was when you purchased the stock. Maybe it faces tougher competition than you thought, or its positioning is worse than you expected. If you realize that the stock pick isn't performing as you had hoped, it might be time to sell in order to either prevent a loss or to invest in an opportunity that can provide a bigger gain. Too often, investors know they made a bad decision but choose to hang in until they can at least break even or get a tiny gain. Don't focus on your purchase price. The stock doesn't know and doesn't care what you purchased it for. The right question to ask is, if I did not already own the stock, would I still want to make the investment in this stock today? Scenario number 6, when you change investment strategy. Different stocks fit into different investment strategies, and the ones that you invested in last year might not be a fit in the forthcoming year. This can happen as you look to reallocate your investments or as a shift in mindset based on other things that happen, such as approaching or entering retirement phase of your life. As such, you might change your investment strategy from growth stocks to dividend-producing stocks, as an example. This change would require you to sell some stocks in order to buy some others. Scenario number 7, when a new opportunity comes along. Warren Buffett calls it simply when something better shows up. If you sell a 20x PE stock to buy a 10x PE stock in the same industry, as an example, or you sell a 3x PEG stock to buy a 1x PEG stock, these would be wise investment decisions justifying sell of the stock you own. And scenario number 8 is to harvest tax losses. Tax loss harvesting allows you to use your investment losses to offset investment gains for tax purposes. The IRS allows you to claim up to $3,000 in net losses each year. Tax loss harvesting allows you to save on your tax bill by offsetting income and capital gains with your losses. If you have a losing stock in your portfolio, you can offset that loss, at least partially, with selling another stock with a gain. These are the 8 scenarios that you might consider to sell. Knowing when you should not sell is as important as knowing when to sell, because it can prevent you from making a mistake that could negatively impact your portfolio. These are the 4 scenarios when selling might not be in your best interest. Scenario number 1, when you hear about negative market conditions. Selling good business on negative market news is usually a bad decision. Selling in panic or in down market is usually not the right time to sell off your stocks, because you will likely make poor sentimental decisions. Just because the markets aren't expected to rebound quickly doesn't mean that they eventually won't come back even stronger than ever, because they always have. Scenario number 2, when you see that other investors are selling. When the stock market is falling, it's not uncommon for many investors to start offloading their shares. However, this can be a big mistake for long-term investment outlook. By sticking to your investment strategy during a downturn, you avoid losses and you remain in a position to profit when the turnaround comes. Scenario number 3, when you notice the stock has gone up. Even if you are sitting on a profit, that's no reason to sell prematurely. While a stock increasing in value might be a cause to consider selling, it's oftentimes a good reason to hold your investment. You should hold into the stock for the duration of your investment strategy. As long as the stock is in line with the actual value of the business, then there is an expectation that the stock will continue to grow along with the business. And scenario number 4, when you notice the stock has gone down. If the stock price is going down, that's not a good time to sell either. In fact, it might be the perfect opportunity to buy more stocks for your long-term investment plan if you believe that the stock is still fairly valued and could make a comeback. The market as a whole typically bounces back, so unless there is a reason that your stock is down, then it might be a good idea to keep your investment and let it climb back again. As the bottom line, investors with a long-term outlook should carefully consider the reasons for selling. There are perfectly legitimate reasons to sell stocks, but it is essential to make sure that you aren't moving away from your investment strategy. As the closing note, it is important to realize that actively managing individual stock portfolio is a time and effort commitment. If you're not able or not willing to make that commitment, you're better off investing into ETFs or have someone else managing your portfolio for you. Buying stocks and not managing them is not a winning investment approach. Please subscribe to this channel to get notified when new videos are available, and thank you for watching.